Hi, my name's Jason Daniels. I'm a director at AssetAccountant, and today I want to discuss briefly accounting versus tax depreciation and why should I care. The main issue. Many accountants prefer just to maintain a tax fixed asset register for their clients and will call depreciation in the financial statements based on the capital allowances defined by the Tax Act. Why is this an issue? Well, firstly, tax tends to be a lot more aggressive in writing off tangible assets than the actual useful life of those assets to the business. This is particularly true when you consider Division 40 and the way that it allows immediate deductions, pooling of assets, and the recent introduction of backing business investment allowances and the accelerated depreciation methods. Assets for tax purposes tend to have a written down value that is much more aggressively undervalued for accounting purposes. Tax written down value typically underestimates the future value of the assets to the business, and relying on tax written down value will typically reduce the value of those assets on the balance sheet, decreasing the profits in the P&L and ultimately undervalues the business. This in turn can impact the business's ability to borrow, its banking loan covenants, and just simply doesn't reflect the current value of the assets to the business, and in summary, impacts the overall valuation of that business to somebody reviewing the financial statements. So what can we do? Well, the most obvious answer is to create separate fixed asset registers for accounting and tax purposes. So a little bit of background. An accounting register. Depreciation is a method of allocating the cost of a tangible asset over several periods of time due to the decreases in the fair value of that asset. It represents the cost to the business of using that asset to produce its income for the period. So specifically, we refer to depreciation here for accounting purposes. For tax, we refer to them as capital allowances as they're defined in the Tax Act. And this refers to the amount a taxpayer can deduct equal to the decline in value of a depreciating asset that the taxpayer holds for taxable use and for a taxable purpose during the year. The deduction is worked out using the provisions of Division 40 of the Tax Act. So going forward, I'm going to try and refer to depreciation as being for accounting purposes and capital allowances being for tax purposes. So what should we be doing for accounting and for tax? Well, for accounting, the depreciation should record the depreciation expense that properly reflects the use of those assets in earning revenue and associated profits. It should allow the balance sheet to correctly reflect the value of those assets to the business as they're used to generate future revenue and profits. Whereas for tax purposes, tax allowances are a tax deduction for the recovery of the cost of assets employed by the business. The business will want to maximise the amount it is able to claim in order to reduce its taxable income and associated income tax in any given year. AssetAccountant allows us to maintain separate accounting and tax depreciation registers so that we can make sure we are maximising the taxable deductions for a client, whilst at the same time maximising the value on the balance sheet. So let's run through a practical example. Consider the following scenario. A taxpayer has decided to open a new gym on 1 July 2019. Gyms are a capital-intensive business. He's leased a premises and purchased $250,000 worth of equipment prior to the opening. For our purposes here, we're going to assume the purchase date and first use date are 1 July 2019. We're also going to assume that the taxpayer is a small business entity for tax purposes. Now, the equipment he's acquired is as follows. 20 weight machines at $6,000 each, 10 treadmills, steppers and bikes at $9,000 each, weights and racks at a total of $25,000, and counters and furniture for $15,000. Brings us to a total spend of $250,000. So the current treatment. Many accountants, as the taxpayer is an SBE, would actually go and claim all of those assets as a taxable deduction and reflect that in the financial statements. Because each asset has a cost of less than $30,000 at the date of purchase, under the simplified depreciation rules, the taxpayer can claim 100% of this expenditure as a tax deduction. If we were to prepare our financial statements based on using tax capital allowances as the basis for accounting, this is what our P&L and balance sheet will look like. So focusing on the P&L first, you'll notice that we've got our membership fees, We've got our capital allowances written off and then some operating expenses. We've got a profit or loss from operations of $192,000. This is also the taxable loss carried forward for the year. Now, on our balance sheet, that has a significant impact. You'll notice that we have no capitalized assets on the balance sheet. We have a number of liabilities in the forms of creditors, GST payable, bank loans, and loans from the owner, and carrying forward our loss from operations. So we have a balance sheet that is in negative equity. This will have a significant impact on the client should they try to go to the bank to borrow to open a second gym or to acquire more equipment for the existing gym, leasing companies, etc. This is something, though, that could easily be managed by capitalizing the assets for accounting purposes and writing them off for accounting using suitable accounting policies. Now, the accounting policies we've chosen for this gym would be that the assets are written off over their useful life of 10 years using the prime cost method. Now, why have we chosen 10 years in the prime cost method? This is the typical useful life for gym equipment. And after all, 20 kilos always weighs 20 kilos. So using the prime cost method, we think accurately reflects that the equipment will get roughly equal usage over the years. So the depreciation versus capital allowances schedule we create to support that, as you'll see on the left, the accounting has us deducting $25,000 a year over each of the 10 years, and the written down value of that equipment declining from $250,000 at cost to $225,000 at the end of its first year, and then reducing by $25,000 for the depreciation each year, right down to the year 2029 when it's written off and would be scheduled to be replaced. But for capital allowances on the right-hand side, you'll see that that $250,000, because we can deduct that using Division 40, allows us to claim that completely up front, and you'll notice that we write that down to zero from day one. That effectively summarizes the difference of our accounting versus tax, and this is what Asset Accountant can do for you. So as you'll see, we've got a much healthier balance sheet and P&L. The P&L reflects the use of that equipment for 1 year, being the $25,000 depreciation expense, and you'll notice we return a small profit for the year. That is expected to increase as the client gets more members and continues to grow their business. You'll notice that we also have a much healthier balance sheet. We've got $225,000 of gym equipment at written down value, which gives us positive assets and positive total equity at the end of our first year. This is going to be a much more positive situation to present to a bank, a leasing company, or any potential lender, should they want to borrow for more equipment, borrow to grow the business, to expand into other sites, etc. It's important to know, though, that the business still has a taxable carried forward loss of $192,000. Our taxable income is still a loss of $192,000 and 82 to carry forward. So why maintain an accounting versus tax fixed asset register? There's significant benefits to the business in maintaining these separately using Asset Accountant. Firstly, we can maximize our taxable deductions while maintaining an optimal balance sheet for accounting. This gives us a much better ability to take this forward to banks, financiers, and other lenders to be able to borrow against our balance sheet. Asset Accountant provides an easy reconciliation of the accounting to tax registers. If you acquire something, you can acquire it for both accounting and tax at the same time. If you dispose of something, it's disposed of for accounting and tax at the same time. Asset Accountant will automatically prepare your monthly journal entries. And if you're using QBO, post them automatically for you. If you're using other accounting systems, it will allow you to export them to Excel to import. We provide a complete range of capital allowance methods for tax purposes, including pools that are not normally used for accounting. This will allow you to have access to the full scope of tax deductions for a client whilst maintaining a strong balance sheet for them for accounting. Profit and loss on disposals versus assessable gains and deductions for disposals are automatically calculated for you. And we have a complete range of tax and accounting reports. Very briefly, the Australian tax methods we currently support. In addition to the traditional diminishing value and prime cost methods, we have the ability to claim an asset for immediate deduction, tag an asset for research and development purposes, make capital allowance deductions under Division 43. We handle luxury motor vehicle caps for both diminishing value and prime cost methods. We have low value pools, software pools, and small business pools. We have separate methods for black hole expenditure and intangibles. You can tag assets for prime production for disclosure in the tax return. And we've just recently released the backing business investment accelerated depreciation methods that will allow you to claim the 50% of assets up to $150,000 upfront where you're eligible. Very briefly, Asset Accountant can help you in your business to manage risk, time, and give you confidence in the fixed asset information that you're currently preparing for you and for your clients. To find out more, please visit us at www.asset.accountant, or you can contact me directly, jason@asset.accountant, or phone me on 0417 791 794.